Welcome back to Investing Talk Podcast.
Today we're looking at Micron technology.
As usual, before we start, subscribe, like, and comment to this video to support the show.
So we're witnessing this completely unprecedented explosion in artificial intelligence right now. I mean, you hear about it literally everywhere.
Oh, absolutely. Every single company is talking about their new language models or their generative software.
Right, they're AI-driven platforms. But what often gets entirely lost in that whole conversation is the physical infrastructure holding it all together.
The hardware.
Exactly, the hardware. You can have the best software in the world, but it means absolutely nothing if you don't actually have the chips to run it.
Yeah, it's just code sitting there.
Precisely. And AI memory demand is skyrocketing at a pace we have, frankly, never really seen before in the history of computing.
It's wild.
And sitting right at the absolute center of this structural shift is Micron technology. They are perfectly positioned to capitalize on this wave.
Because it's not just about making more chips, right?
No, not at all. It's about making the exact type of highly specialized memory that makes modern artificial intelligence functionally possible.
And I think that brings us to the core tension we need to explore today. Because if you are looking at the projections for this company,
The growth numbers are just staggering.
staggering. They are the kind of numbers that make you do a double take. You check to make sure you didn't misread the chart.
Right.
But at the exact same time, if you look at the recent stock performance, it just took a profoundly punishing hit.
It really did.
So we have an immense disconnect here. For you listening right now, our mission today is to cut through the noise, bypass the panic, and figure out exactly what is going on beneath the surface.
Yeah, we have to dig into the data.
We are going to answer the million-dollar question: is this recent drop a dangerous value trap that is just going to keep falling? Or are you looking at one of the best multi-year entry points the market has ever offered in the semiconductor space?
Exactly, because the narrative right now is incredibly polarized. You have these extreme bulls, and then you have terrified bears.
Yeah.
To figure out where the truth lies, we have to peel back the layers of what the broader market is reacting to on a day-to-day basis versus what the underlying business is actually executing on behind closed doors.
Well, let's unpack the fundamentals. We need to look at the raw numbers first, because the revenue and earnings trajectory here is almost hard to comprehend.
Staggering is really the only word for it. Let's look at their fiscal Q1 2026. They reported revenue of $13.6 billion.
Wow.
That is up 56.7% year over year. Think about how difficult it is for a mature company of this size to grow its top line by almost 60% in just a 12-month window.
It's massive.
Okay.
And where is that coming from?
Well, if we break down that $13.6 billion, you have $10.8 billion coming directly from DRAM.
And for anyone unfamiliar, DRAM is essentially the high-speed, short-term working memory, right?
Yes. Absolutely crucial for rapid processing. Then you have another $2.7 billion coming from NAND, which is their technology for long-term storage. Okay. They are hitting absolute record achievements across the board, particularly in their data center segments, where that AI demand is heavily concentrated. And their fiscal Q2 2026 guidance, they are projecting $18.3 to $19.1 billion.
So they are pacing toward what, like $74 billion for the full year?
Exactly, pacing for a massive $74 billion for full year 2026.
I was looking at their margins, and the jump from last year is almost hard to believe. How did they pull that off? Because a year ago, their gross margins were sitting at 39.5%.
Right?
But in Q1 2026, those adjusted gross margins hit 56.8%.
That margin expansion is the critical key to this entire story. Going from roughly 39% to almost 57% is a phenomenal leap in profitability.
It really is.
To put that in perspective, imagine a coffee shop suddenly being able to charge 50% more for the exact same cup of coffee simply because they're the only place in town that knows how to brew it.
That's a great way to look at it.
It reflects incredible cost discipline, sure, but more importantly, it shows raw, unadulterated pricing power. They are selling higher volumes at significantly higher average selling prices.
And the bottom line projections reflect that, obviously.
Oh, absolutely. When you drop that kind of gross margin expansion down to the bottom line, the earnings per share projections become explosive.
What's the other numbers?
Analysts are currently projecting a fiscal 2026 EPS of $32.19. That is a 300% year-over-year leap.
A 300% increase.
Yes. And because of the persistent structural shortages in advanced memory, there is a very clear line of sight to an EPS of $42 by 2027.
So what exactly is driving this immense pricing power? What is the competitive moat that allows them to charge these premiums and expand their margins so aggressively without customers just going to a competitor?
It comes down to three letters: HBM, high bandwidth memory. If you want to understand this company right now, you have to understand HBM. Standard memory chips simply cannot move data fast enough to keep up with the latest AI processors. It creates a severe bottleneck.
The processor is basically starved for data.
Exactly. High bandwidth memory solves this by stacking memory chips vertically. Think of it like building a densely packed skyscraper instead of a sprawling single-story suburb.
Right, taking up less physical footprint but packing way more in.
And then widening the lanes for data to travel up and down. It is incredibly complex and delicate to manufacture. And here's the kicker. Their HBM capacity is completely 100% sold out through the entirety of 2027.
Completely sold out. That is wild.
It really is. Trying to get your hands on advanced high bandwidth memory right now is like trying to buy Taylor Swift tickets in 2023.
Good luck.
Right. It doesn't matter how much money you have in your budget, the supply is just gone. It's spoken for. And because it is completely sold out, they hold all the cards at the negotiating table.
Which explains the pricing power.
We are seeing prices for current generation HBM3 rise by 15%, and the next generation HBM4 is already commanding a 50% premium over that.
Wow.
They have an absolute stranglehold on this critical component of the AI supply chain.
And we also have to factor in the financial health and the strategic advantages provided by the U.S. HPS Act. This feels like a huge piece of the puzzle that often gets overlooked.
Definitely.
They are receiving up to $6.4 billion in direct grants and tax credits to fund new fabrication plants in New York, Idaho, and Virginia.
Which completely transforms their balance sheet. Building a state-of-the-art semiconductor fab is one of the most capital-intensive projects on planet Earth.
Just massive upfront costs.
Huge. Let's define that really quickly. Capital expenditure, or CapEx, is the billions of dollars a company has to spend on physical buildings and equipment before they can even manufacture a single chip to sell.
Right.
By getting $6.4 billion in government funding, it dramatically strips away that capital expenditure burden. It essentially allows them to build out the massive physical capacity needed to meet this insane AI demand without taking on excessive debt.
Or diluting the business for their shareholders.
Yeah.
It also completely changes their geographic risk profile, doesn't it?
Absolutely. It heavily limits their exposure to China, which is a profound geopolitical advantage right now, given current tensions. And it gives them a localized, heavily subsidized supply chain right here in the United States.
Which gives them a leg up on the international competition.
When you compare that to their primary Korean rivals, Samsung and SK Hynix, it's a vast edge. They were building a localized HBM production powerhouse that competitors simply cannot rapidly replicate.
Pivot to the charts and price action, because this is where the story gets really complicated.
Yeah, it does.
We just outlined this beautiful, flawless, fundamental picture. Sold out inventory, 300% earnings growth, billions in government subsidies. But if you look at the recent trading, it has been absolutely brutal.
It has been very tough for anyone watching the daily ticker. There's no question about it.
Let's look at the actual numbers so you, the listener, understand the scale of this. On March 3, 2026, the stock closed at $379.68. That was after nearly an 8% drop in a single trading session.
Painful.
And if that wasn't painful enough, the very next day, March 4th, it dropped another 7.6%.
Yeah.
You are looking at a staggering destruction of market value in a 48-hour window.
Right.
For an investor holding this in their portfolio, that kind of price action is terrifying. It naturally makes you wonder if the broader market knows some dark secret that the fundamental data isn't showing us.
That is a very natural reaction. When you see a sea of red, the instinct is to panic. But we have to rigorously contextualize this price action. What you are seeing on the charts right now is not a company-specific fundamental reversal.
It's macro.
Yes, it is a sweeping industry-wide event. The entire semiconductor sector has been under immense pressure. When you look at the technical structures, this back-to-back drop represents a temporary pullback to historical support levels.
It's not a fundamental breakdown.
Not at all. It is a violent pullback, yes. But the institutional targets haven't wavered. In fact, Morgan Stanley recently came out and raised their price target significantly, moving it from $350 all the way up to $450.
So if the underlying fundamentals are entirely intact and top-tier analysts are actually raising their targets, what exactly is driving the momentum and flow so aggressively downward? Why are we seeing this high volatility?
It is entirely macro-driven. The sell-offs are being triggered by geopolitical shocks and rising fears around global energy prices.
Right.
When large asset managers and institutional algorithms get spooked by macroeconomic uncertainty, they broadly de-risk their portfolios. They pull money out of high-beta tech stocks across the board.
Let's define high beta really quickly for anyone who isn't familiar with the term.
Sure. Beta is a measure of a stock's volatility in relation to the overall market. A high beta stock is inherently more volatile and sensitive to market swings than the average company.
So it amplifies whatever the market is doing.
Exactly. If the broader market drops, a high beta stock tends to drop even harder. So in this case, it doesn't matter if the company is completely sold out of HBM through 2027. If the automated algorithms and macro hedge funds are dumping semiconductor stocks to reduce risk, this specific stock is going to get pulled down in the current.
It's just getting caught in the riptide.
The volume and the volatility we're seeing are tied directly to those external energy and geopolitical fears, not a structural flaw in the underlying business model.
Which, if you are a strategic investor who can stomach the roller coaster, presents a very interesting scenario.
It creates a tremendous accumulation opportunity. The underlying structural demand for AI memory hasn't changed by a single percentage point during this two-day sell-off.
The data centers still need the chips.
Desperately. The backlog is still entirely sold out. When the macroeconomic noise eventually settles down, the technicals suggest a rebound that implies a 30% to 80% upside in 2026. The technical setup right now is essentially a tightly coiled spring held down by broader, unrelated market fears.
Moving over to market sentiment. We really need to dissect how the broader market is perceiving all of this right now. If you look at the current news cycle, it is dominated by mixed, largely neutral to bearish noise.
They're very noisy right now.
The headlines are intensely focused on geopolitical fears, specifically the escalating tensions involving Iran and the broader Middle East. We are seeing these global events act as powerful drivers, sinking semiconductor stocks across the board.
Yeah, you see it on every financial network.
The narrative in the financial press is heavily skewed toward this macro fear. Now, to be clear, we are just reporting on what is driving the market here. We aren't taking a stance on the geopolitical events themselves, but the reality is that they are dictating the current financial news cycle.
Right, and it's vital to recognize that those geopolitical events are real and they do move markets. But beneath those loud, fearful headlines, there are incredibly bullish undercurrents that are largely getting ignored by the retail trading market.
What kind of undercurrents are we talking about?
Look at the long-term industry partnerships. Lam Research just announced a major facility expansion in Boise, Idaho. This isn't just a random real estate move for them.
They're doing it on purpose.
This expansion specifically deepens their physical and strategic ties to Micron technology for AI memory demand and research and development collaboration. These massive billion-dollar supply chain players are physically positioning themselves closer together to tackle the AI memory bottleneck.
That makes a lot of sense.
When you physically co-locate your R&D teams, you dramatically cut down your iteration cycles. That tells you everything you need to know about where the industry insiders see the demand going over the next 3 to 5 years.
You don't spend hundreds of millions building new state-of-the-art facilities right next door to a partner if you genuinely think demand is slowing down anytime soon.
Exactly.
And that kind of quiet conviction isn't just isolated to supply chain partners, is it? We are seeing deep institutional belief in this AI boom as well. If you look at the Q4 2025 regulatory filings, David Tepper's Appaloosa Management maintained their position.
Which is a huge signal.
When one of the most historically successful hedge fund managers in the world is holding strong through the brutal volatility, it signals that the smart money is looking way past the current geopolitical noise.
Exactly. And the reason the heavy institutional money is staying put comes down to the speculative valuation gap. This is perhaps the most compelling part of the entire sentiment story.
The valuation gap.
Because of the recent violent price drops, the stock is currently trading at less than 10 times its projected 2026 earnings.
Let's pause on that. Less than 10 times earnings. For a company growing its earnings by 300%, that sounds broken.
It does.
Let's define forward earnings for a second. That basically means we are looking at the stock price relative to the profits analysts expect them to generate next year, right?
Correct. And a multiple of less than 10 is an astonishing anomaly. When you compare that multiple to other AI-adjacent peers who are currently trading at 30, 40, or even 50 times forward earnings, this is a screaming value. To use an analogy, this stock is basically sitting in the discount clearance bin, while the rest of the AI sector is being priced like luxury designer goods.
People are just walking past it.
The market is pricing this like a legacy, low-growth hardware company, totally ignoring the fact that it is a critical, completely sold-out linchpin of the global artificial intelligence revolution. If the broader market suddenly wakes up and realizes that GPU demand is going to continue exceeding expectations through 2027 and 2028, we could see major upward revisions.
And that valuation gap will close violently to the upside.
Without a doubt.
We have to look at the bear case. We can't just talk about the upside and the clearance bin valuations without seriously stress testing these assumptions. As a natural skeptic, my mind immediately goes to the historical nature of this specific industry.
The cyclicality.
Yes, memory chips are historically one of the most notoriously cyclical boom and bust commodities in the entire tech sector. Historically, whenever prices go up, companies get greedy, they overbuild factories, they flood the market with cheap supply, and prices inevitably crash.
It's happened before, many times.
Furthermore, they are facing intense, incredibly well-funded competition from Samsung, SK Hynix, and the rapidly emerging NAND sector heavily backed by China. How do we know this isn't just the absolute peak of another cyclical bubble right before a devastating crash?
It is the single most important question you could ask. The cyclicality of memory is a brutal historical reality. Anyone who traded tech in the 2010s remembers those painful boom and bust cycles. And you are entirely right to point out the competition. Samsung and SK Hynix are aggressive, highly capable rivals, and China is pouring billions of state funds into their domestic chip capabilities to close the gap.
Not to mention the vulnerability we literally just witnessed. The stock dropped roughly 16% in 2 days because of macro shocks and energy prices. It feels like if the global economy sneezes, this particular stock catches a very severe cold.
Those risks are entirely valid, and anyone investing here needs to be aware of them. But here is why the core thesis holds up robustly against them. The traditional memory cycle, that historical boom and bust you mentioned, was based on highly standardized, commoditized chips for everyday PCs and smartphones.
Stuff anyone could make.
Exactly. Anyone could make them, so supply easily outstripped demand. High bandwidth memory is absolutely not a commodity. It is highly complex, custom packaged logic that is incredibly difficult to yield at scale.
Okay, that changes things.
The risk of sudden market flooding oversupply is vastly lower because the manufacturing bottlenecks are so extraordinarily severe.
So the sheer engineering complexity actually acts as a protective barrier to entry.
Precisely. It is simply too hard to make for competitors to easily flood the market. And regarding the fierce competition and the macroeconomic shocks, we have to look at their specific built-in mitigations.
Let's hear them.
First, as we covered, their HBM backlog is entirely sold out. You don't have to worry about scrambling to find buyers in an unexpected economic downturn when your production is already spoken for through 2027.
It's guaranteed revenue.
Second, their gross margins are robustly above 40%. Even if there is some unexpected pricing pressure on their older standard memory lines, they have a vast cushion of profitability to absorb the blow without dipping into the red.
And the CHIPS Act.
And finally, yes, the U.S. government subsidies provide a monumental safety net. That $6.4 billion heavily insulates them against the massive capital expenditure risks that would normally sink a hardware company during a cyclical downturn. Let's get to the final verdict.
We've looked at the explosive top-line growth, the incredible margin expansion, the brutal recent price action on the charts, and the very real historical risks of the memory sector. How do we synthesize all of this data into a cohesive takeaway for the listener?
After heavily weighing all the data points, the fundamental catalysts on the horizon, and the current significant market discount, we are formally presenting a bullish score of 9 out of 10.
Wait, a 9 out of 10? Even with the stock dropping nearly 16% in 2 days and the historical boom and bust cycle of memory chips? You're that confident in the data? Give me the elevator pitch summary.
I am. Here is the bottom line. We're looking at a highly visible path to 30% to 80% upside in 2026. This is being driven by 57% surge in earnings per share.
Incredible numbers.
They are operating behind an impenetrable ETFs Act-funded moat that shields them from international rivals, all while their most critical product, HBM, experiences unprecedented global shortages and delivers massive pricing power.
And regarding the timeline, because patience is usually the hardest part for anyone watching a stock violently bounce around in their portfolio.
The target horizon here is a multi-year hold. You are ideally holding this through the 2027 HBM peak, those recent macro-driven dips that drag the price well below the $450 institutional targets. Those aren't reasons to panic and hit the sell button.
There are opportunities.
They are an absolute gift for value-oriented investors looking to gain exposure to the foundational infrastructure of the AI boom at less than 10 times forward earnings.
It really paints a fascinating picture of exactly where we are in this current technology cycle. I want to leave you with a final lingering provocative thought to consider based on the data we've covered today. If the sole US-based memory giant is completely 100% sold out of its most advanced chips for the next 2 full years, despite massive government funding and highly aggressive factory expansion, what does that mean for the physical limits of the global AI revolution?
It's a great question.
Can software algorithms continue to evolve and scale at light speed if the physical earthly hardware required to run them is functionally maxed out? It is something to seriously mull over as you watch this incredible space develop. As usual, before we close out, subscribe, like, and comment to this video to support the show. Thanks for listening, and we'll catch you on the next one.